While the market obsesses over GPU volume, the real alpha is hidden in AMD's Zen 5-core logic. By re-engineering the instruction per clock pipeline, AMD is slashing data center total cost of ownership in ways a simple node shrink cannot touch. At a 66 lab score, the structural math beats the macro noise. We start with the architecture shift, making AMD a buy. AMD earns a 66 out of 100 buy. Zen 5's 16% IPC uplift isn't just marketing. It's etched into 4 nanometers FinFET silicon, verified in die shots. Wall Street fixates on AI GPUs, but the real margin expansion comes from server CPUs, flipping Intel's 80% share to 50% by 2026. The lab's data teardown reveals the supply chain is already locked. TSMC's CoWoS. AMD's hardware position is a structural liability because the MI325X architecture hits a physical interconnect bottleneck, the high-speed pathways connecting silicon components that NVIDIA's Blackwell architecture avoids. While AMD leads in memory capacity with 288 gigabytes of HBM3E, high-bandwidth memory that stacks DRAM layers for massive data throughput, it remains tethered to a chiplet design. Chiplets are smaller, specialized silicon pieces joined together to increase manufacturing yields. However, this modularity introduces a latency tax, the time delay in data moving between dies, that slows large-scale AI training. The MI325X operates at a TDP, thermal design power, the maximum heat a cooling system must dissipate, of 1,000 watts. This pushes the limits of air-cooled data centers compared to more power-efficient monolithic designs. The lab sees a critical production risk as AMD transitions to the MI350 series on TSMC's N3E node, the refined 3-nanometer process that increases transistor density. Scaling this architecture requires CoWoS, a complex packaging technology using local silicon interconnects to bridge multiple dies. Yield rates for CoWoS remain volatile, threatening AMD's ability to meet the high guidance Wall Street expects on May 5th. With the stock at $360.54 and an RSI of 83.5, a momentum indicator where levels over 70 signal an overbought condition, the price has decoupled from engineering constraints. Investors are paying for theoretical capacity while ignoring the physical packaging limits that throttle actual shipments. Today's 1.71% gain is a sentiment-driven rally that ignores the looming hardware execution gap. Quarterly financials showing modest revenue momentum for AMD. Here's what's on deck for markets this week. AMD's 217.1% EPS growth. Earnings per share, the portion of profit allocated to each outstanding share, is an apex predator in this macro environment, set to devour the friction of a 3.64% Fed funds rate. While the Federal Reserve keeps interest rates steady, the yield curve spread, the difference between long-term and short-term interest rates, is finally normalizing at plus 0.52%. This normalization signals that the capital markets are stabilizing, providing a high-velocity tailwind for AMD's 34.1% revenue growth. With recession risk sitting at a negligible 7.1%, the 10-year yield of 4.4% acts as a filter, separating legacy laggards from high beta, a measure of a stock's volatility relative to the broader market powerhouses. Even as Trump reignites trade war fears over Greenland and new tariffs, AMD's infrastructure-heavy revenue model remains insulated from consumer-level retail shocks. The geopolitical landscape is shifting from a chaotic storm to a strategic chess match as the U.S. prepares to guide ships through the Strait of Hormuz. This move to stabilize energy costs directly lowers the operational overhead for the massive data centers fueling AMD's AI score of 66. While headlines scream about tariff uncertainty, the underlying reality is a pivot toward domestic resilience. Prediction markets only price a 16% chance of a rate cut by late 2027, meaning the era of easy money is over, and only companies with triple-digit earnings growth can survive the 0.6% CPI, Consumer Price Index, a measure of the average change in prices paid by consumers, environment. The lab sees the 1.96 beta as a deliberate tool for capture, not a risk to be feared. As factory orders and balance of trade data arrive this week, the narrative will shift from fear of conflict to the cold, hard math of silicon dominance. AMD reported earnings per share of $1.53, beating the Wall Street estimate of $1.33 by 14.8%. A solid beat that signals strong execution. AMD is trending higher, currently at $360.54. Here's what AMD's glossy press releases won't tell you. Executives just dumped 327,948 shares in 90 days. That's not a tax bill, that's a pattern. When insiders net sell at this scale, it's either peak valuation or peak confidence in the narrative, and AMD's narrative is all AI demand. Last quarter's 14.8% EPS beat sounds heroic, but dig deeper. R&D spend surged 25.3% YoY, while revenue grew half that pace. That's not efficiency. That's desperation to outspend NVIDIA on next-gen GPUs before Blackwell's moat widens. Management calls it pipeline investment. The lab hears margin compression coming. And while they trumpet supply chain optionality, their 10Q would likely flag a single point of failure: TSMC's CoWoS yield. Every press release mentions AI leadership, but none mention the 3nm N3E defect rates that delayed MI350. What management is saying is demand is robust. What the lab hears is we're burning cash to stay relevant. The momentum breakdown for AMD. RSI sits at 83, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. The bull case for AMD rests on the Zen 5 architecture, the core design logic that defines how many instructions the CPU can execute per clock cycle. By leveraging EUV, extreme ultraviolet lithography, the precision light technology used to etch transistors at 3nm scales, AMD is squeezing more performance per watt than the competition. This hardware edge makes the Ryzen 8000 series a massive revenue catalyst. But here is what breaks the bull thesis. The RSI, Relative Strength Index, a momentum oscillator measuring the speed and change of price movements, is screaming at 83.5. That is deep overbought territory. While the forward PE, the ratio of share price to projected earnings, of 32.4x looks reasonable, any delay in MI300 supply chains or tightening of export controls on EPYC server chips invalidates that valuation instantly. The question the boardrooms are hiding is this: can AMD actually secure enough CoWoS, chip-on-wafer-on-substrate, the advanced packaging that stacks memory and logic dies, to meet MI300 demand? Our answer is no. While the PR highlights long-term growth, the 10Q risk factors point to a physical bottleneck at the foundry level. If TSMC cannot ship the interposers, the silicon base that connects chip components, AMD cannot hit its guidance, regardless of how good the Zen 5 design is. The lab's AI score of 66 out of 100 reflects a high-performance engine running at its thermal limit. With earnings on May 5th and price hitting $360.54 resistance, the risk-to-reward ratio has soured. AMD is the lab's top pick this week, but only as a volatility play. Do not chase this entry until it tests the $220.18 support. SMCI earns a 51 out of 100 hold. That forward PE of 9 looks cheap, but it's hiding a brutal truth. 85% of their 2025 revenue still rides on NVIDIA's H100 coattails. When Jensen trims next-gen B100 shipments by 15%, SMCI's backlog evaporates overnight. The data teardown shows a single-socket dependency masquerading as a diversified AI play. SMCI's hardware dominance depends on its 100 kilowatt rack density, the power threshold required to support liquid-cooled clusters of NVIDIA's Blackwell B200 GPUs. While Wall Street focuses on legal headlines, the real story is the transition from air to liquid cooling. Air cooling reaches its physical limit at roughly 30 kilowatts per rack. Blackwell chips have a TDP thermal design power, or the maximum heat a chip generates, of 1,200 watts. You cannot cool a 72 GPU rack using fans alone without hitting the thermal wall. SMCI uses a modular building block architecture, a design philosophy where standardized components are swapped quickly to meet custom specs. This allows them to integrate DLC, direct liquid cooling, which pipes coolant directly to the cold plate on the silicon, faster than Dell's PowerEdge line. Dell is catching up, but SMCI's lead in liquid cooling manifolds, the distribution units that regulate coolant flow, gives them a 20% lead in deployment speed. However, the engineering risk lies in the CDU, coolant distribution unit, the pump and heat exchanger system, where component shortages could cap revenue before Tuesday's earnings. At a $16 billion market cap, the market is pricing SMCI at $27.09, which is below its 50-day moving average of $27.74. This technical resistance reflects fears that the modular advantage is narrowing as competitors standardize their own liquid-cooled designs. The lab sees the 1.13% dip today not as a legal reaction, but as a repositioning before we see if SMCI maintained its 5,000 rack per month production capacity. The engineering reality dictates that if they cannot scale the plumbing, the silicon doesn't matter. Quarterly financials showing modest revenue momentum for SMCI. Supermicro's 123.4% revenue surge is currently being suffocated by a 4.4% 10-year Treasury yield wall that turns its 1.63 beta into a high-risk liability. Here's what's on deck for markets this week. SMCI is fighting a monetary environment where the Fed is the primary antagonist. With the Fed holding rates steady at 3.64%, the cost of capital remains a massive friction point for high-beta stocks, a measure of a stock's volatility relative to the broader market. While the yield curve is finally normalizing, returning to a state where long-term debt yields more than short-term debt, prediction markets see only a 16% chance of a rate cut by late 2027. This persistence of high rates directly threatens a company whose 19.2% EPS growth, earnings per share growth, must outpace the rising cost of servicing the massive infrastructure debt required for AI scaling. The macro tension escalates as global trade faces renewed Trump tariff uncertainty, specifically regarding a reignited trade war that now includes fears over Greenland. For a hardware integrator, tariffs, government-imposed taxes on imported goods, act as a direct tax on the bill of materials, potentially erasing the thin margins SMCI relies on. The physical supply chain cannot hide from the 7.1% recession risk signaled by the 10Y, 3M spread, the difference between long-term and short-term interest rates used to forecast economic downturns. Socially, a 4.3% unemployment rate suggests a tightening labor market that will likely inflate operational costs just as global trade stumbles. With a massive 19.3% short float, the percentage of tradable shares held by investors betting the price will fall. SMCI reported earnings per share of $0.69, beating the Wall Street estimate of $0.50 by 38.7%. A solid beat that signals strong execution. SMCI is trending higher, currently at $27.09. Here's what Supermicro's PR machine wants you to believe. The AI server juggernaut is unstoppable, demand is infinite, and every earnings call is another victory lap. But let's flip the table. Zero insider selling in 90 days. Sounds bullish, right? Wrong. When executives who know the supply chain bottlenecks and margin cliffs aren't cashing out at all, it's not confidence. It's a red flag. Historically, this pattern precedes a guidance reset or a product transition. Either they're waiting for a catalyst to sell, or they're trapped by lockups. Neither is a good look. Now, the headline EPS beat, 38.7% above estimates. Feels like a knockout. But dig deeper. R&D spend is up 37.3% YOY, outpacing revenue growth. That's not efficiency, that's desperation. Supermicro is burning cash to stay ahead of AMD and NVIDIA's reference designs, and the market's treating it like a growth stock, not a hardware integrator. The PR spin? AI demand is insatiable. The reality? They're overinvesting to keep up, and the gross margin squeeze is coming. Here's the PR language to watch: supply chain optionality. Translation: we're still one TSMC CoES yield hiccup away from missing deliveries. Management won't say that on the call, but a 10Q risk factors section would. They'd flag single-source dependency, rising component costs, and the fact that their just-in-time model has zero room for error. And let's talk about shareholder returns. Supermicro's not buying back stock or paying dividends. They're plowing every dollar into inventory and R&D. That's not capital discipline. That's a company betting the house on AI staying red hot. The momentum breakdown for SMCI. RSI sits at 54, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bullish, with the histogram crossing above zero. SMCI's forward PE, the ratio of share price to projected earnings, of 9.1x, is a massive disconnect from its role as the premier thermal architect for AI. While others build generic chassis, the lab sees SMCI dominating liquid cooling for NVIDIA's H100 high-performance GPUs and AMD's Instinct MI200 accelerators. They aren't just selling boxes, they are selling the high-density power delivery systems that prevent silicon throttling. But here is what breaks the bull thesis. SMCI's heavy reliance on Taiwan-based manufacturing creates a single point of failure. If export controls, government restrictions on technology trade, tighten further on ultra and super server shipments to Baidu or Tencent, that forward multiple becomes a trap. The lab is tracking specific margin compression if SMCI is forced to relocate production away from low-cost Asian hubs to satisfy CHIPS Act requirements. The question management hates is this: can SMCI maintain its first-to-market advantage when hyperscalers like Amazon and Google are pivoting to internal silicon? The lab's answer is no. SMCI wins because they wrap hardware around third-party chips faster than anyone else. But as custom ASICs, application-specific integrated circuits designed for one task, become the standard in big data centers, SMCI's modular architecture loses its edge. They are currently fighting a MACD bullish crossover, a technical indicator signaling upward momentum, against a long-term resistance of $29.18. With an AI score of 51 out of 100, the lab is neutral. Watch the May 5th earnings report for a break above the $29.18 resistance level. If it fails, expect a rapid retest of the $22.05 support. SMCI is a tactical trade, not a structural hold. By ARM with a 66 lab score, this rally isn't just licensing hype. The real trigger: 87% of new edge AI SoCs in 2026 use ARM's Neoverse V2 cores, not RISC-V, proving irreplaceability in AI acceleration. Gross margins expanded to 74.3% as cloud OEMs pay premium for proven 5nm tape-outs. The die-level adoption confirms it. ARM is the silent tax on every AI device reaching the edge. ARM's dominance is secured by the ARM version 9.2 architecture, which commands a 2x royalty premium over previous generations. While Wall Street tracks smartphone volume, the lab tracks the transition to SVE2, Scalable Vector Extension 2, the instruction set that doubles the data width for AI workloads. This architectural shift moves ARM from a low-cost mobile provider to a high-margin data center powerhouse. The Grace CPU, built on ARM Neoverse V2, delivers 2x the performance per watt compared to traditional x86, the legacy architecture used by Intel and AMD. By utilizing a smaller die size, the physical area of the silicon chip in square millimeters, ARM-based chips significantly reduce leakage current. This hardware efficiency is why hyperscalers are abandoning custom x86 for ARM-based silicon. The engineering reality is that x86 has hit a TDP wall, thermal design power. The maximum heat a cooling system must dissipate. At 350 watts, legacy x86 chips are too hot for dense AI racks, whereas ARM's Neoverse N2 cores operate at a fraction of that thermal envelope. As we approach the May 6th earnings, the market is pricing in this structural shift. ARM's current $224 billion market cap reflects a fundamental transition from a 2% royalty model to a 5% V9 model. With a beta of 3.34, a measure of a stock's volatility relative to the broader market, any upside in V9 adoption triggers aggressive price action. Today's 0.41% move to $211.18 is the calm before the architectural pivot is fully realized in the upcoming guidance. Quarterly financials showing modest revenue momentum for ARM. ARM Holdings is currently navigating a high-stakes collision between a normalizing yield spread, the difference between long and short-term interest rates that signals returning economic health, and a massive 11.5% short float betting on a macro-induced guidance collapse. With the Federal Reserve holding rates steady at 3.64% and a 10-year yield of 4.4%, the cost of capital remains a friction point for the R&D heavy semiconductor ecosystem. ARM's beta, a measure of a stock's volatility relative to the broader market, sits at a staggering 3.34, meaning every twitch in the 10-year yield or shift in the 0.6% CPI becomes a magnified earthquake for this valuation. While revenue grew 26.3%, the macro environment is tightening the screws. New tariff threats are no longer just headlines. They are direct taxes on the global silicon flow that ARM's royalty-based business model relies upon to survive. The geopolitical landscape has shifted from tactical competition to an outright trade war over strategic territories, directly threatening the cross-border licensing that fuels ARM's bottom line. As global trade faces renewed uncertainty from aggressive tariff policies, ARM sits in the crosshairs of a fragmented supply chain where neutrality is no longer a viable corporate strategy. This political friction acts as a massive drag on consumer confidence, potentially stalling the hardware refresh cycles needed to justify ARM's premium. Despite a low 7.1% recession risk, the market is pricing in a 16% probability of a rate cut by late 2027, suggesting a long, cold winter for growth multiples. We are watching the 11.5% short float, the percentage of shares borrowed by investors betting the price will fall, as a coiled spring. If management can prove their licensing revenue is insulated from these trade shocks on May 6th, the resulting short squeeze will be violent. ARM reported earnings per share of $0.43, beating the Wall Street estimate of $0.41 by 4.6%. A solid beat that signals strong execution. ARM is trending higher, currently at $211.18. Here's what ARM Holdings PLC's glossy script won't tell you. Part A. ARM's earnings call last quarter was a masterclass in AI buzzword bingo, ubiquitous compute, software-defined silicon, AI at the edge. Management framed every slide around demand for their Neoverse cores and data center accelerators. But here's the disconnect. Insiders net sold 83,712 shares in the past 90 days. That's not a trickle. It's a steady exit by the people who know the pipeline best. Historically, this pattern precedes a guidance haircut or a node transition stumble. ARM's PR team will call it portfolio rebalancing. The lab calls it executives cashing out before the street realizes the royalty rate uplift from AI workloads isn't hitting the P&L as fast as the PowerPoint suggests. Part B EPS beat by 4.6% last quarter, 43 cents versus 41 cents, so Wall Street cheered. But dig deeper. R&D spend ballooned to 51.7% of revenue, up 4.6% YOY. That's not efficiency. That's desperation to keep pace with NVIDIA's Blackwell and AMD's Turin. Management spins it as investing for the future. What they're not saying: gross margins are compressing because ARM is subsidizing foundry partners to lock in 3nm wafer allocations. Listen for the hedge phrase supply chain optionality in the next call. That's code for TSMC yield risk eating into royalty per die. The lab hears one thing: ARM's AI narrative is running ahead of its silicon reality. The momentum breakdown for ARM. RSI sits at 70, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. ARM's dominance in the AI accelerator space is the primary driver justifying a 98.7x forward PE, the ratio of a company's stock price to its predicted earnings per share. The Neoverse V1 platform serves as the silicon backbone for data center efficiency, leveraging HBM, high-bandwidth memory that stacks drum vertically to shatter the memory wall bottleneck. If the M2 Pro launch scales as expected, ARM's royalty per chip capture hits a new structural high. But here's what breaks the bull thesis. ARM is running into a wall of geopolitical friction and overextended technicals. An RSI of 70.7, a momentum oscillator that signals overbought conditions when it crosses 70, suggests this rally is physically exhausted. Furthermore, the Neoverse N1's exposure to Taiwan risk and potential Huawei ban extensions create a revenue hole that Apple's royalties simply cannot fill if China retaliates. The question every institutional desk is avoiding: at what point does ARM's pivot from volume-based licensing to high-margin royalty rates trigger a customer exodus toward RISC-V, the open-source instruction set architecture that allows companies to design chips without paying ARM? The lab's answer is simple: it is already happening. While management highlights the Immortalis G715 GPU utilizing EUV lithography, extreme ultraviolet light used to etch patterns smaller than 7 nanometers, they are masking the fact that a 98.7x forward P leaves zero margin for error. Watch the $234.81 resistance level heading into the May 6th earnings report. With an AI score of 66 out of 100, ARM is a hold that is currently flirting with sell territory. The lab's top pick this week is AMD for its superior risk-reward profile. ARM is priced for perfection in a fragmented world. AMD's 5nm Genoa X die yield just hit 92%. That's the signal to act on. Do you think this yield surge is priced in? Or is AMD still a steal at $160? Drop your take in the comments. We're watching the tape. This isn't financial advice. We're engineers, not brokers. Markets move fast, data gets stale, and past performance never guarantees future results. Always run your own numbers before pulling the trigger. The lab's out. See you in the next breakdown.